Inflation rate is currently up 8.3% year over year. This is way above the FED's benchmark target of 2%. Interest rate increases usually come in at 0.25% increments. So what happens when this value hits a hike of 0.75%? Hey everyone, and welcome back to Everything Tesla Stock. Inflation has been a major stumbling block for businesses, not exempting Tesla. The cost of commodities has risen exponentially in the last few months, and this has affected sales and profit margins across various organizations. For Tesla, it's caused an increase in prices of raw materials and components needed for manufacturing its cars, consequently leading to price hikes in Tesla vehicles. Elon Musk recently disclosed that inflation is weighing heavily on Tesla, and the prices of Tesla cars are now at embarrassing levels. Amidst the plunging economy, Tesla is struggling to keep up with the car demand and keep the prices from increasing further. While it seems that the automaker is beginning to find its balance, there may be another headwind for Tesla to battle. The Federal Reserve recently announcing its new hike in interest rates. Is this something that Tesla investors need to be worried about? Well, you're about to find out, but before we do, if you like this type of content, don't forget to like and subscribe, and don't forget to turn on notifications to keep up to date on everything going on with Tesla. The Federal Reserve recently announced a third consecutive hike in interest rates of 0.75%. According to the FED, this was done in a bid to reduce the persistently high inflation rate. Inflation has continuously eaten deep into the economy in the last few months, and new economic projections show a possible decline in economic growth in 2023 and the rest of this year as well. The raise, which was recorded as the fifth straight increase to the federal funds rate, brings it to a range of 3% to 3.25%. It's the highest it's been since 2008, and according to the Federal Reserve Chair, Jerome H. Powell, there is a need to get past inflation, and to do that the prices of commodities will have to come down and demand will have to match supply. By increasing the interest rate, FED hopes that spending will reduce, which will lower inflation on the prices of goods and services, and also bring demand back in line with supply. The FED believes that one major factor that contributes to inflation is the demand in the economy, which is still too high amid a plunging global supply. Therefore, reducing consumption and borrowing could in turn put downward pressure on prices. Powell stated that people are suffering from high inflation, especially vulnerable households, and will suffer more if the FED fails in its commitment to pulling down the prices of commodities. Although he admitted the harsh effects this will have on people, he did add that there was no painless way to do it. Speaking on the issue, Vice President of the Economic Studies Program at the Brookings Institution and a former FED economist, Stephanie Aronson, stated why she thinks the move will have a greater benefit in the long run. According to the financial expert, it is better that the FED increases interest rates now rather than fighting inflation halfway, backing off and having to do it again when higher rates come in. So, what does this mean for Tesla and its stock? Increased interest rates are going to result in higher cost of capital, which will make it difficult for companies to borrow and go forward with aggressive growth plans. Reacting to this news, Elon Musk stated that he's not in support of the move, as he thinks that inflation is already coming down. Musk said sometime in July that he thinks inflation will decline towards the end of the year, adding that the prices of commodities will eventually trend lower. However, Powell does not seem to share the same opinion as Musk. According to him, he is not trying to help investors or boost the stock market, but is instead only interested in reducing inflation by making capital restrictive. Now, this may seem like the FED is trying to crash Tesla stock, but that's not what it is. It is only trying to slow the economy by using higher interest rates and more restricted monetary policies, thereby slowing down the expansion and growth plans of companies. However, some analysts believe that the FED may be overdoing it. And also, as access to capital is going to become too restricted, and because of this, it's going to be a problem. According to these analyses, the increased interest rate may actually be disastrous in the long run and eventually result in a huge mistake. But do you think these analyses are right in their prediction? Let us know down below. With the interest rates at their highest level ever recorded, this will likely cause the economy to slow down. A major downside to the rate hike is increased monthly debt costs for Americans and further increase in the cost of debt for credit cards, vehicle financing and other loans, but it does not affect fixed-rate car loans already in place. It will, however, increase interest costs for new auto loans or those with variable rate financing. Bankrate's chief financial analyst Greg McBride stated that with the recent hike, the average interest rate on a 60-month new car loan would push up closer to 5.5% to 5.75% from a rate of 3.85%. This was recorded from the beginning of the year. This is about an extra $31 per month in auto financing payments for a $35,000 new car. At this rate, a lot of people may actually be discouraged from taking out loans for cars. Also, there's an expected increase in the rate of unemployment. Joe Brusuelas, chief economist at RSM, disclosed in a recent note that to get inflation rates back to 2%, job losses could go well above 5.3 million, resulting in unemployment rates of 6.7% at the upper end of the range. Although interest rates do not directly control rates in mortgages and other loans, it does influence how much banks and other financial institutions will pay to borrow, which consequently affects loan pricing. The question is, though, will this new interest rate affect Tesla's stock valuation? Well, this is possible, but it does not mean it will directly. The main driver of Tesla's stock valuation, and pretty much any stock in the chart, is investors' expectations for the stock. If Tesla investors expect that a higher interest rate will excessively restrict capital and slow the economy, then the stock market is likely to react. Following the recent disclosure by FED, Tesla's stock price recently dropped nearly 30%, way above its 15% increase over the last year. This may be said to be as a result of fear and uncertainty among investors' expectations for the coming quarters. Then, the hike in interest rates may have little or no effect on Tesla's valuation. There are a few factors, though, that can enable Tesla to scale up its profit margins in the coming years, despite high interest rates. In the words of popular stock investor and YouTuber Dave Lee, Tesla has a lot of tailwind going forward. First, they have a high demand for their products. Second, they've got high margins right now, and these margins are improving. Thirdly, they're ramping up new factories in Austin and Berlin, which should actually increase the revenue and margins because of the cost of efficiency improvement in manufacturing in these new factories. Dave Lee believes that Tesla's FSD beta software and the anticipated US tax credit can further boost the automaker's revenue and profit margins. And this is, in fact, true. These factors are likely to increase investors' expectations for Tesla stock, further preventing a drop in price. Also, the highly anticipated AI Day 2 is another event that Tesla investors are excited about. Musk announced in June this year that Tesla's second AI Day event will be held later in September. According to him, a working prototype of Tesla's humanoid robot is going to get unveiled at the event, with other interesting projects that the car company is working on. Several Tesla fans and analysts are looking forward to this event, and many have revealed how optimistic they are about AI Day 2 boosting Tesla's valuation in the long run. Aside from the Tesla bot, investors are also hoping to get updates on the Tesla Robotaxi and its Dojo supercomputer. If Tesla can successfully come up with convincing updates on these projects, then investors may have no reason to doubt the company's potential, or lower the valuations and price targets. And since Tesla's AI Day is more of a recruiting event, it may actually be able to attract the best engineers to work on these projects, making them a reality. However, although Tesla shows a huge potential for increasing its revenue and car sales in the coming years, it is still important to keep an eye on the market performance. According to Dave Lee, the stock market may experience more volatility in the next quarters, and Tesla stock is still very vulnerable to the aftermath of the increased interest rate. Likewise, some experts predict that inflation will remain high at the end of the year, possibly 4.5% using FED's preferred gauge before it falls closer to normal levels this year. While Tesla may have effective strategies against inflation now, it is never certain what the future holds. What do you think about FED's recent take on interest rates? Should Tesla investors be bothered about the aftermath of this and what it may mean for Tesla stock? Let us know down below, and if you'd like to know more about what Tesla's been up to in the last few days, go ahead and click on the next video on your screen. See you there.